Welcome everyone, episode 29 of The Wide Lens. I've got Matt Rigby here and we're going to cover the latest topics in financial markets. Apologies for those watching episode number 28. We had some technical glitches at the 40-minute mark, so no video of us, just the audio, but I'm sure you can...
I don't know, is that worse or better? I don't know.
Hear our voices, not see our faces. We've got a few things to cover today, and I reckon we've got a few, well I do, a lot more director's cuts, which I reckon just some snippets of stuff that I think are really interesting at the moment. But let's kick off with Matt's Mark a minute. We'll get into it.
Okay, so over the last week, the Aussie 300 down about 1% up, and it's down 7.3 year to date. Companies coming out with earnings, those that beat, Reece, the plumbing group, down about 2.6. WiseTech up about 8.7. Coles down about 3 with soft guidance. Altium up around 20%. Hub, the investment platform, up around 0.6, so flat. Net wealth coming out at 2.45, or up 2.5%. Both coming out with pretty good numbers. Lots of good inflows there. Wesfarmers down about 1.7, coming out this morning with earnings that beat. They're optimistic about Bunnings and Kmart as family budgets come under pressure and they start to trade down. Interesting.
That's what Coles are talking about too.
Oh, were they? Oh, the $1 pasta? I saw. I read the headline. That was it.
Bastardising every other product on the shelf.
That's all home brands, right? I mean, that's where they're going. Anyway, companies that met. It's always nice to see a few just meet, not beat, not disappoint. Breville down about 3.7. Reliance Worldwide down about 9. Uncertain outlook there. They've got a bit of exposure in the UK, so no big surprise there. And Lendlease down around 1%. Companies that missed, this is surprising. Domino's, man, everyone's buying pizza, right?
Well,
they're not.
Pizza Hut's making a comeback.
That's right. You've been banging on. You've been on the Pizza Hut train for a bit. They're down about 6.5%. Service Stream down around 22.5%. Their revenue beat, but earnings missed. And missed in a bit of a way there. Endeavour, the spin-off from Woolies or Safeway or whatever they're called these days, down around 13.5%. Adairs down about 10%. Soft guidance, probably an insight into the consumer as well. And Cochlear flat. A couple of companies, and one just breaking news, Rob. Breaking news coming across the wires right now. Ramsay Healthcare just announcing that KKR.
I thought you were going to mention another stock. I was shaking my head. I saw Ramsay. I saw KKR coming out. Yeah, literally hot off the press.
There are a lot of international companies. I feel like this is a bit of a trend. Aussie dollar's low, stock prices are down, private equity coming in, opportunistic bids. So
aren't we in a recession?
I don't know. I don't think the answers. I think yes and no are the answers there. All right. A couple of other stocks of interest. EML, the payment company, came out with good earnings. They beat. But then a couple of days later came out and announced that they had discovered some fraudulent activity within their direct debit processing division in Europe. And that's from a company they bought just last year. Not a great buy. They've had a few of those in Europe, actually. Potential loss up to 25% of financial year 22 earnings, and not great. Another blow to their business. So not great there. I think, was it early this year they had a manager, the CEO left? I can't remember. Anyway. And this is probably the one you thought I was going to talk about. Zip came up with somewhat decent earnings, down about 10.5% for the week. Came out and announced that they're closing the UK and Singapore business. That will reduce costs by about 50 million a year. Pretty good move. Looking to close other international branches. They made a cash profit before tax, but a $1.1 billion loss when they factor in write-downs. Noted that they had seen a slight pullback in discretionary spending, which I thought that was noteworthy. And that their platform allows for customers to pay their bills, groceries, food, utilities. So basically using buy now, pay later. And they've seen a big uptake in that, which got me thinking, I wonder, is that a bit of an indication that people are struggling? They're using this instead of a credit card to sort of get by? Don't know. We'll know in time. All right, NASDAQ down just under 2% for the week, still down 20% year to date. 49 companies are down more than 20%, 20 are in positive territory. The S&P 500 down about 1.5% for the week, down 12.5% year to date. 144 companies or 29% down more than 20%. No, sorry, I've got that all bloody backwards. 144 positive, 170 down more than 20%. Some earnings, Palo Alto Networks up 12%. These companies beat. Zoom beat, down 15%. I think we'll have some more of that later. Toll Brothers, the transport company, down about 0.5%. JM Smucker, which is the people and food, dog food company, pet food probably, up about 2.75%. Dick's Sporting Goods down 2%. JD, the Chinese online everything, up around 17%. Macy's, can't believe they're still around, down 5%. Intuit, the accounting software company, down just under 1%. Victoria's Secret, maybe people are pulling back, down 10%. And Salesforce, down around 6%. A couple of companies that missed, Urban Outfitters, down 2%. Discretionary spending, maybe. Royal Bank of Canada, down 2.5%. And NVIDIA came in a bit light, down around 2.5%. Emerging markets up down 1.5%. Year to date, down 13%. Oil up 2.3% for the week, up 23% year to date, trading at $92 US a barrel. Petrol prices, mate, have just bloody skyrocketed. I don't know what's going on there. But
I haven't filled up in the last couple of weeks. Deb has. So
I don't know what's going on.
But I think it's diesel's still under $2. So I'm happy.
Yeah, well, petrol's back up to 190. And Bitcoin up about 2%.
Maybe Scott Morrison's 6-month things expired. Remember the 6 months?
September or October. We're probably getting close. Yeah,
okay.
Bloody Labor putting taxes up already. Surprised that's not the headline in the Herald Sun. Anyway, Bitcoin up 2%, down 55% year to date, 21,578 a coin. Just a bit of economic data that I thought was interesting. Jackson Hole is happening this week, and that's just basically tonight. Powell comes out with his kind of speech and whatever. So it's just a bit of a economic powwow away from the hustle and bustle of the city. Wyoming is where Jackson Hole is, if you're interested. Middle of, I don't know, nowhere country, I guess. Don't know, haven't been there. Anyway, his comments, pretty widely anticipated. They're definitely going to change or influence the direction of markets.
Do you feel like markets have just been waiting for... So by the way, we're recording this on Friday, the 26th of August. And so tonight our time will be the
big man speaks.
Jay Powell's speech. Do you reckon markets are just waiting for some guidance from the Fed chair?
I do. I think markets have been pretty directionless this week. I also feel that markets kind of have taken a view that interest rates were at the end, and we'll get towards this, or we'll talk about this in a bit, but I think markets are anticipating the number of rate increases and the size of those increases start to come off. I don't know. I don't think we're there yet. And I think if he comes out and says something like that, we're going to see a sell-off, would be my guess.
Why is that? Does the market want more?
I think the market's not expecting the Fed to keep the pedal flat to the floor and, keep coming out with 75, 50 basis point hikes. I think the market's expecting that we're kind of near the top. Maybe there's 1 or 2 hikes left, and then we're going to start to pause and then start to see them drop. I just don't think they're there. I think they want to see a pretty sustained drop in inflation. We've had 1 month. That's nothing, It's pretty volatile data. So I would imagine that will continue. On the back of that, 10-year Treasury rate has increased from 2.88 last week to 3.09.
Yeah, right.
So
I didn't see that.
Popped up a bit. It was at 2.5% at the start of the month. That's a massive increase. All right, so just some other PMI numbers in Europe, pretty mixed. Manufacturing PMIs have slipped. They're in negative territory at about 49.7, so anything below 50 is deemed contractionary. A bit above expectations. The services number is sitting at about 50, down from 51, and slightly below expectations. So manufacturing is a bit weaker. Services also a little bit weaker. In the UK, similar sorts of things. Industrial production tumbling based on their measure, -7 from a +8. Forecasters were expecting a +3, so that's a big miss. And what's the other one I've got there? I thought I had... there it is. Services was at 52.5 from 52.6 and above expectations. So services, that is restaurants, etc., doing relatively better in the UK, but I think that's all heading south.
Europe is really struggling at the moment, aren't they?
They are, from a manufacturing standpoint in particular. Services,
but what was their inflation? What was it, 18%? Was that right?
I don't know if it was 18%. What do we saw last couple of weeks ago? It was over around 9%. I think expectations are it'll hit 18%.
Oh, was that what it was?
I think that's
Bloody
what it was.
Headlines. So it's high single digit. They're contracting really quickly. You've got their gas and energy prices absolutely going through the roof.
Just going
Winter.
Winter's about to hit. I saw that the Russian gas company, Gazprom or whatever, they've shut down the pipeline again for maintenance work. Very conveniently timed. I think they're in a world of pain.
Yeah. People are talking about a second half recession for the Eurozone.
Yeah, I
which would be...
don't know how they are not in recession.
Yeah.
The Bank of England came out and said all of next year in England will be a recession. 4 quarters. Just write it off. All right, very quickly, US PMI, manufacturing PMI fell to 51.3, so still positive, but getting down a little bit. And the services PMI dropping to 44.1 from 47, and that is way below expectations.
It's a big drop,
good. It is. And new home sales tumbled about 12% in July after dropping 7% in June, so that's coming off. But on a positive note, and we'll bring up this chart, this graphical of America, unemployment rates. So the unemployment rate declined in more than half of American states in July, with a record 22 of them reporting jobless rates below 3%.
Is that a record?
The unemployment rate?
The rate, those lows?
I don't. It is for these particular states.
I see.
Yeah, this
record
is the lowest for these states.
But not for the United States.
I don't think for the US
It would be pretty bloody close though, wouldn't it?
It's got to be close, absolutely. So, look, some positives there, I guess. But unemployment's a lagging indicator. So
yeah, it is.
A lot of the leading indicators are looking pretty bad.
Yeah, they are. I mean, you just touched on a number of them. People are already talking about Eurozone in recession, and BOE confirming that next year will be
the whole year. Look out.
So the couple of things I wanted to quickly chat about. I won't spend too much time on these. You've touched on a lot of them already. The slowing down economy. It's obviously a very confusing time in the market right now, whereby people are talking about the slowdown, yet the data that's coming out is not supportive of the apparent slowdown.
Yep.
So I'll bring this first chart up now. It's the durable goods orders that came through for July. They were flat at 0. Didn't Biden say that inflation was 0 like a month ago?
Did he?
Yeah. He was being a bit cheeky with the numbers. But so once you exclude volatile air transportation and defence, in fact, durable goods orders rose 0.4%, which is the 5th straight month of increase. And you can see the decline in mid-2021, early 2022, the negative 0.4, negative 1.7. But you've got positive numbers since then. Now, like the thing that I'm thinking about is we're talking about what's going on in the economy. You just mentioned that the jobless rates are at record lows in those states, and as a country, if not pretty damn close to a record number.
Yep.
Now, the record unemployment, durable goods orders. I mean, you talked about PMI in the Eurozone. US is still in expansion territory. These still indicate that people are still spending money. There's no pullback in people's expenditure. Companies are still hiring. And I think in Australia we've got like 1.8 job openings, almost, which is, I believe, is a record for every one unemployed person looking for work.
That's right. Yeah.
So it's almost a 2 for 1, which I believe is a record for Australia. So there's no sign of of jobs being cut, no sign of pullback on capital spending over the last month or two, or the last 5 months. And so I think the important thing here is to just look at the data that is coming out and not focus so much on the words that people are talking. In other words, response to surveys, what the headlines are saying, etc. Do you want to add anything to that? I feel like I just want to reinforce central banks always talk about data driven, right? They don't care about sentiment. And I feel like sentiment and actual data at this point in time are probably have the biggest gap that I've ever seen between the 2 points. What do you think?
Yeah, no, I agree. And I don't, it's confusing, if people are feeling as bad as what they're saying, why are they not pulling back in a meaningful manner? And, I think 3 or 4 months ago, we were talking about this and saying, all right, maybe the data will play out. But it's played out in a very similar fashion in that it hasn't shown, that pullback hasn't really shown up yet. I don't know. It's really weird.
Because credit card companies are saying the same thing.
They are. Visa, MasterCard came out and said we haven't seen a major, and Starbucks came out and said we haven't really seen a pullback in discretionary spending. There's little bits here and there, but it's not wholesale, not like you would expect if we were, diving headfirst into recession.
Yeah. How much longer do you think we can keep this narrative up until, does the narrative keep going and it's self-fulfilling? To the extent that we keep talking about it and investors and the market just becomes so bearish that they actually stop spending?
What have we had? 6 months of it already? When did it start? March, April? I think as long as the Fed keep raising rates, I think this story will continue, and eventually it'll play out. That we'll have a recession, assuming the Fed continue to push rates up. If the Fed go another 1.5-2% from here, you would expect that maybe at that point it starts to bite. I don't know. Are people chewing through savings?
I reckon they are.
I don't know.
It's we haven't seen up-to-date data, but you and I have always talked about corporations and consumers that have been in the best position they've ever been to weather a recession.
Yep.
Could it be possible that a soft landing is actually a genuine option that could play out?
I believe that was referenced a couple of weeks ago here on this podcast. Look, I think people are saying that there's no chance it'll happen. I don't know. That's the same old adage that everyone's on one side of the boat saying the Fed can't do it. What if they do? Maybe not of their own doing, but just what if it happens?
That's what happens.
Is strong. Yeah. It's not an impossible outcome.
Do you want to maybe jump onto your topics there? Yeah. I reckon, the next, I'll sort of get into what I want to chat about, which I think will feed off on that really well.
All right. So are interest rates coming down? So I'm jumping way ahead of the curve here. So
you are a futurist.
Apparently. So I was reading, I don't even know, I think it was Barry Ritholtz had republished this or used a bunch of charts from Charles Schwab and some of their data. But basically, the premise is what are central banks doing? Where have they come from? What are the markets kind of looking at going forward and in terms of interest rates? And then what has the share market done on the back of that? So let's bring up this first chart. And so near a peak in rate hikes. So this is a bit of an odd chart, but essentially what it's doing is totaling of 115 central banks around the world. What number are hiking rates? What number are cutting rates? And what's the net position from a global? So if you take it as this is the world's interest rate cycle, if you like. And you can see, 2020 there were only a couple of countries hiking, or relatively few, but most were cutting, and now the opposite has happened. There's, 30 odd countries that are cutting, and the vast majority there are hiking rates, and the net is a pretty strong positive. If you look at that number relative to history, and granted there's only 20 odd years here, which is not a big span of history, but the furthest back I could find. We're at peaks. We're at peak for net. We're at peak for total number hiking. So people are starting to ask, as they
That's interesting to look at it that way.
Yeah, I thought so. That's why I put it in.
Excellent. Full of insights. What was Barry's point of view, or what was Schwab's point of view on this?
Well, it wasn't... They didn't really have a strong point of view. It was just sort of let me keep going, and maybe their point of view sort of starts to feed through. They didn't have a kind of, this is where we're at and this is what's going to happen. It's just sort of, historically, here's where we are. So what's the market's outlook for interest rates over the next, say, 16 odd months? So we'll bring this next chart up, and the shaded area is the kind of forecast.
Oh, yeah.
And you can see there, the blue line, the US Fed, the green is the UK, and the other colour, what's that, orange, the ECB, Europe. And you can sort of see that, rates are expected to peak, early next year. We'll call it Jan, Feb, March.
Which is not far away, right?
It's not far away. Man, it's bloody coming at us fast. That's been a fairly, what's his name from CBA?
I thought you were going to talk about Chris Joy for a second.
No. Gareth something or other.
Gareth, yeah.
And I've seen a couple of others come out now and say, Australia will peak late this year and start to cut, in the back end or second half of next year. And that's very similar to what's kind of happening here. So you can see, the US, for whatever reason, has got a longer forecast or a greater forecast, but they all follow that same sort of trend. And, I think to your point just before, the US is the one that's expanding and consumers are still spending. So they're probably the one that are going to continue to lead the rates up.
Sure.
Arguably, the UK and the ECB, maybe they start cutting earlier, but it depends on what their focus is. If it's unemployment, they cut earlier. If it's inflation, they probably
Where do you reckon the RBA
later.
sits on that scale or that chart?
That's a good question. I don't know. Maybe more in line with the US, but not as high. I think it's probably, I think we probably get to a peak and stay there for longer than as opposed to
as decline.
Keep going up.
Gotcha. Yep.
So we may decline at the same time, but we might just flatline for a bit longer.
Yep.
So that's sort of what the market's expecting. So rates to start coming down the back half of next year. So, then I guess the question I had is, well, what happens when we get to peak rates? Do we stay there for a while? Is it up and down? Do we, kind of down and get back up? What happens? So we'll bring up this next chart. So monetary policy tended to transition quickly from hikes to cuts over the past 50 years.
Right.
Which, it surprised me, but it didn't.
So what do you mean? How is this chart showing that? So if I look at the ECB,
probably not
because there's
ECB.
a couple of periods there in the early 80s where if it's flatlining, there's nothing happening.
There's nothing happening.
You're talking about rises, falls. Okay,
I'll talk about the ECB in a minute. They're a little bit different in a number of ways, but the blue and the green are probably the key ones to look. So you can see there, which is what, 1960, 1980? I can't quite read. I think it's 1980.
72.
Is it?
Yeah.
The US kind of raised rates, and then it sits there for a very short period of time and then drops. And then in the 80s, they raise rates, drop them, increase them, drop them. And they're quite volatile when you think about it, when you look at it. And there have been very few instances where they've raised rates to the peak and it's stayed there for any period of time.
There haven't been?
No. I mean, if you look at the early 90s, it stayed there for a few months, you might say, and then it fell. The Bank of England, the same sort of period. Granted, it was a higher. It stayed there for a bit longer, and then it's plummeted. So they don't tend to hover at that high point. It's almost like the interest rate increases do their work, go too far, which is why we're saying soft landing can never happen. They go too far, and then they have to cut to
come back down. Yeah.
And
you and I have always looked at, and when we bring up charts around interest rate rises, recessions always follow when rates peak.
Yep.
It's happened every single time.
Yeah, and
so does that mean then if the market's pricing in a peak at 2023, our recession's coming in 2023?
That, history would suggest. that's the case. So the reason the euro are a little bit different, and some commentary here. So the ECB and its predecessor to the German Bundesbank tend to move relatively less. So they tend to be less reactionary. So they're maybe you could say they're more considered in their views. So they'll raise rates, kind of sit there, see what happens, raise rates again. It's not bang, 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 and we've gone too far, cut.
Gotcha. That's an interesting
So
point
historically, they've been a lot slower, a lot more patient in their increases, and they tend to be a bit more gradual. However, the other thing I guess to note is when they cut rates, it was typically due to unrelated developments, such as the European debt crisis in 11. That's kind of what forced them to cut.
How is that unrelated?
Well, it's unrelated in that if you think about the German Bundesbank as opposed to the ECB, but it was unrelated in terms of it was Italy, Greece, Spain, Turkey.
That's the deal, man. You're the Eurozone. You're one now.
But the vast majority of Europe was still doing quite well.
Wow.
And they had to cut interest rates to save these guys.
Sure.
All right.
But I think that's the issue, right?
But the GFC in 08 had nothing to do with Europe. And the dot-com bust in 2000. Again, they cut rates in response to what happened in the US.
So we're blaming the US for everything.
Pretty much they're blaming the US, which is a very European thing to do. So in the US, they tend to go up and down quite a bit.
I'm not buying it.
What, about Euro or?
No, just about
Mr. Skeptic.
We're cutting rates through no fault of our own. It's because of somebody else. That's how the world economy works. You're going to participate in a globalized economy.
Sure. But I think their point is we were raising rates to reduce...
because we had a strong economy.
To reduce overheat. Well, I mean, yeah. So reduce overheating and inflation here, and we had to cut because of an external shock.
There are always external shocks.
What was an external shock for the US GFC dot-com bust? That was internal shocks. Yeah, anyway, okay. You're distracting me. In the US, so since 1970, what do we got here? So let me just get this. Oh, in 11 of the one-year periods where they've hit a peak. So in the US, history shows that after each of the last rate hikes by the Fed, so you've had your last rate hike, yes. The S&P 500 index, on average, posted a 15% gain over the next 12 months. So
after the peak?
After our peak. So we hit our peak of interest rates, the S&P 500 goes up on average 15%
yep.
in the next 12 months. So since 1970, this has happened. There have been 11 instances in America where we've had peak rates, and in 8 of those, the market, the S&P 500, has gone up on average 15% or more. The others are obviously dragging that average down. In the UK, in 7 of the 11 periods where we've had this, about a 9.4% on average gain 12 months after peak rate.
Sure.
So typically, I guess what I'm getting at is once we hit peak rates, not that we know, but once we get there and 12 months on from there, the market actually does quite well. And in Europe, it was about 0.1%, so basically flat. And the reasoning for that was they hit peak rates at times when there's global crises, and that's why they're cutting rates, and then the market doesn't really react because of that. However, the expectation is that that's going to change because they're now moving rates more in line with the US and the UK, whereas they haven't previously.
Yeah.
And so the last chart I'll just bring up here before you make a comment is just showing that graphically. So the US is the place to be when we've hit peak rates, essentially.
Isn't the US the market to be in?
It's the place to be all the time, let's be honest. Yeah. I mean, the one thing I did kind of chuckle at when I saw this is, man, look at the European market. Like, what the fuck's the point? Just don't worry about it.
What are they doing?
I don't know, man. I mean, since they went to the euro, they've pretty much been a basket case.
Yeah.
For the vast majority of that period. Even if it is America's fault.
No, that is America's fault because they had to go to a Eurozone.
To Euro to compete with the US. And so the Germans...
So whose fault was that?
Yeah, I don't know.
There's no ego in that.
The Queen's probably. But yeah, I don't know. Anyway, European markets,
Bit of a basket
don't do
case.
particularly well.
Do you think you can almost just throw out the world economy and say just invest in US stocks? That's what the US do, don't they? Their allocation to offshore markets is negligible to zero.
Yep. Which makes sense. I mean, if they're, I don't know what percentage of the global economy is represented by the US, but it's the vast majority. I mean,
The global economy?
40 odd percent. I think it used to be more than 50%. And I know that the US market is more than 50% of the MSCI world. It's like 60, 54%.
So after adjusting for purchasing power parity, which I don't want to do, the US accounts for just under 16% of
is that all?
global GDP
Man,
after
that's way
adjusting
out.
for PPP.
So 16. Okay, that's pretty small.
Yeah, it is. Although there's a good visualization here from Visual Capitalist. In 1960, US share of global GDP used to be 40%. It's down to now 24. This is as of 2019. And it's hovered around 23, 24% since
so they're
2010.
a quarter of the global
Quarter of the
economy.
world.
That's less than I was expecting, but still a decent amount. What do you think, Rob? Are we at peak? Are the markets
what?
right to start looking at rate decreases?
Well, the market
Over
is.
the
You've just shown that chart.
But
earlier.
is that the right move? Do you think is the market getting ahead of itself?
Well, the market always is getting ahead of itself and looking out. What's that? Another 18 months.
Well, when do we hit peak though? I think that's probably the better question. You know, if we hit peak in let's say March of next year, what's that? 7 months away?
In Australia?
Globally. Or the US here, based on this chart.
So we're sitting at March 2023. I don't know. I've got no reason to think that shouldn't be. It just sort of feels right. I feel. Do you remember when where were interest rates supposed to go? Remember they were supposed to be rates were supposed to hike like 15 times, and we were going to ridiculous levels of interest.
Yeah, it was 3% here in Australia, and I want to say,
but
someone was coming up with like 5%.
I feel like you got to give the market some credit. Like we're almost there. We're almost at the not quite. We've got a couple more.
We're 185, right?
Well, okay, 185. We have another 50 points. What are we at? 235. So what does that mean? We've got 3 hikes to go in Australia?
Well, we've got 1.15, however many hikes that takes.
Yeah, so call it 2 to 3 hikes. Do you think the RBA will go 75 points?
At the next meeting?
Yeah.
No.
50?
Probably.
Okay. So then we got a couple. So you're pretty close to 3%.
We're not too far off, yeah. Yeah.
And I reckon we'll probably hit that by the end of the year. And then
Do you think the RBA will get to 3%?
In the high 2s.
Yeah.
2.8, 2.85, something like that. I mean, I'm just like, what's the big deal about that? And I want to talk about normalisation later on, but why is that such a big deal?
Well, I think it's a big deal because of where we come from and the relative debt, notwithstanding fixed rates, variable rates. But I think it's a big move. You know, we had a client in earlier this week saying, you know, rates for a particular loan, the repayment was almost doubling, like getting close to that double mark. And I think, I think a lot of people are in that bucket. Fixed rate is maybe what's saving the Aussie economy or retail spending at this point. And the proportion of fixed loans that you have relative to variable is probably a pretty good indication of how much you're feeling the pain.
I still think there's a lot of money slashing around. The lunacy, is it lunacy a word? Like,
No, we'll make it a word. It's now a word.
so the lunacy of 2021, I think we're just seeing that unfold now.
Yeah, it'll be really interesting when we get updated bank account balances, you know, those aggregate numbers, to see what's happened over the course of this year. There's so many people are traveling to Europe and European tourism. I mean, I think that's why their services side is holding up pretty well and manufacturing's falling off.
Notwithstanding a weak Aussie dollar.
Yeah, absolutely. But what happens when we hit winter and no one's traveling in Europe? I mean, I think it gets pretty ugly.
I feel like we've got a longer runway than what we may have originally thought, and that's, I believe, cushioned by cash reserves, consumers, and businesses.
Yeah.
The soft landing, maybe we do have a soft landing. I don't know. I feel like anything's possible.
Oh, absolutely.
Anything is possible.
As long as, I think, some of the commentary from the Fed guys at the moment is, no, we're going to keep hiking rates, hike rates. As long as they can, try and resist the urge to hike rates based on what the data's showing today, and have a bit of a look into, okay, well, what's the trend of the data? Is it now trending down? Okay, well, maybe we need to reduce the hikes or pause to see what it shows over the next however long. And I think that's why we have this boom bust, if you like, increase decrease cycle.
Yeah, because you can never perfect that, right?
Because the data's backwards looking, and it takes
It's
a couple
a month,
of months
quarter
to have an effect.
Yeah. And look, let's remember that rates are also rising because the economy is strong.
It's doing
like,
well.
can we just remember there's a reason why rates are rising?
Yeah, and inflation, is high, but a lot of it's external driven.
Well, we can be supply chain. We can be like the Europeans and say it's external factors.
It's all external.
It's all external factors.
Slow and steady, I think.
But some of that is genuine. I mean, I think a lot of it is genuinely external factors that interest rates are going to have a tough time curbing because, I mean, look at the gas issue. Like, with interest rates rising, I don't know, maybe you get to a point where people just aren't turning stuff on anymore. I don't know. In my lifetime, I've never lived in that type of environment. Sure. I don't know if you have.
No.
But maybe they're like, what?
I'm not that much older than you, mate. But yeah, I mean, the ECB raising rates to bloody 50%. I mean, maybe that's what stops people turning on the gas, but it doesn't affect the gas price because it's driven by supply and demand in Russia and Ukraine.
That's right.
I think.
What else do you want to chat about this? I feel like I didn't really answer your question about interest rates.
You tend not to, so that's cool. I think that's basically it. So, as we hit peak rates, US market tends to do a lot better than elsewhere. And
which has been the case for a number of decades now.
And the market's expecting peak rates early next year.
So if you want to talk about markets, last week we talked about the 50-day moving average, the 100-day moving average, and the number of stocks breaching their 50 and 100-day moving averages. And the next tell was going to be that 200-day moving average, whereby you had more stocks for a longer period of time. And we talked about, the topic was trust the thrust, and the thrust failed.
Don't trust it.
Don't trust the thrust. The market was on the verge of just hitting that 200, exceeding the 200-day moving average. I think it clipped it and just couldn't push any further, and it's fallen since then. We've seen that over last week. In fact, over the last week since we recorded last week's episode number 28. Sentiment Trader had a really interesting take on that. A lot of analysis is now going out at the moment about what happens when you have the 50 and 100-day breach and you get, within 1% of the 200-day moving average and it doesn't work out. So I'll quickly read this from Sentiment Trader. For the first time in several months, the S&P approached this 200-day moving average on Monday, and so far it failed to pop above it. Similar behaviour led to large losses in 1930, decline of 34% over the next year, 1973, a decline of 40% over the next year, 2001, a decline of 23%, 2008, decline of 34%. This only includes times when the index spent more than 63 trading days of at least 1% below its 200-day average. It got close to this in 2011, 2020, didn't quite meet the criteria. Since 1928, there have been a dozen similar failures in the couple of days following an approach to the 200-day moving average. They go on to say those are cherry-picked disasters that the bears will focus on, but there were 9 times when the rejections didn't mean much. 7 of them preceded double-digit gains over the next year. And so they're saying there's actually the S&P was actually twice as likely to see large gains the following year than losses the following year, twice as likely. So I just wanted to point that out, that last week we were super bullish and we were just almost at that finish line to hit that 200, but unfortunately we failed. But I remember you, as I was putting my notes together for today's episode, I remember last week you said that you had felt like the market had gone from oversold to overbought really quickly.
Yeah.
But you also threw in the comment that you were of the view, and correct me if I'm wrong, that you would have algos and quant-based trading picking up these technical indicators. And that manifests on itself, right? You got the 50, you got the 100, and then you got the 200, and so forth. Maybe some of this has got to do with Jackson Hole and what Jay Powell's got to say. Maybe it doesn't. But I think your comments last week were really important. And now with the fullness of time, we've gone from really quick oversell to really quick oversold. And maybe this is not the end of it. Well, definitely not the end of it, but short term.
Hope it's not the end of it.
Maybe the market just needs a breather. Maybe the market did rally really hard, really quickly. I mean, the NASDAQ jumped more than 20% in 6 weeks, 7 weeks, something like that. So you've gone from 6-month bear market to 6-week bull market, just really sharp changes like that. And maybe this is the breather we need. Maybe it's not. What do you think about that?
No, I agree with my comments from last week. I think I was spot on. No, I think you're right.
You are the futurist.
Well, yeah, I mean, the NASDAQ, it's only down 1.7 for the last week. Now, it was up pretty strongly last night. S&P is the same.
Yeah.
I just did, I think at the very core of market trading is human emotion. And, we're emotional creatures. So we get a few buy days, a couple of nice earnings reports, and we all get super excited and we're buy. I mean, it's that cartoon. And then we're sell. I don't know that we're going to test the lows that we saw in June. I don't. We may not. Who the hell knows?
And if we don't, do you reckon we're pushing harder over the next 12 months?
Yeah, probably. Because I think if we don't, let's just say, I think I said last week, it wouldn't surprise me if we saw a 10% pullback from where we were. I mean, 10% is nothing. Let's say we get 10% and then we rally again, we hit this 200-day moving average. We burst through, then I think it's on for young and old, just from a technical standpoint. The other thing to note is, technical trading is one thing, but the fundamentals are a lot of companies are out there producing good earnings, and the outlooks haven't been uniformly bad. I mean, there's a few companies here or there. Yes. Even in Australia, there are a few companies that are kind of sounding a little cautious, but there's a lot of optimism out there still, as we said earlier.
We've got private equity coming and buying out of companies, right?
Yeah. I mean, and this is happening more and more and more. I mean, it's almost this idea they're just loading up the boats full of dollars and shipping them over to buy whatever they can buy at the moment. That's kind of how it's starting to feel. And at some point, in Australia in particular, at some point we're going to wake up and go, oh shit, our economy is pretty good, our unemployment rate's not bad, interest rates aren't that high relatively speaking, and things look pretty good, and markets might start to rally.
I certainly don't feel like the market is uber bullish. I mean, everyone's bearish at the moment, right? So that you just don't have that vibe.
I also think it's pretty fragile.
Yeah, it is, because that's the vibe right now. And if I sort of reflect back on other instances where we've had a bear market rally, we're kind of in a bit of a bear market. It's not until you have the fullness of time that you look back and you think, shit, we actually should have bought back then, right?
Yeah.
And that could, I mean, if you remember the GFC, when the market bottomed out in 2009, people were still bearish up, right through 10, 11, 12. Then we had the European debt crisis.
That's right.
People were bearish for years beyond that.
Yeah.
And I'm not saying that that's what it is right now, but it could be possible that we're reliving a very similar situation right now.
Yeah, and you come out of a decline like we've had. I mean, you don't bounce and just go 45 degrees up to the right.
No,
I mean,
unless it's COVID 2020.
Of course, but I think to your point, we're going to see more volatility, but we're probably through the worst of it.
Yeah, look,
as the market drops 20% next week,
if we're not testing the lows of June, then I agree with you. I think we're on.
Yeah, and look, I think tonight it shouldn't be pivotable, but it will be. And if Powell comes out,
but it will.
Yeah, if Powell will come out and say whatever he says, and the market will react pretty strongly. I think one way or the other. Like I think we're going to see a decent move. Yeah, and it could be a decent couple % down.
Yeah.
Again, wouldn't surprise me.
Let's move on to, we've got a new sort of a temporary segment here within Director's Cuts where I've got a few things here. Well, it's not a new segment. I'm just calling
Rob's
it
Director's Cuts.
So a few things that stood out to me that I feel like a director's cuts, but somewhat of a continuation of the topics we've been talking about. You might know a bit more about this than I would. Biden coming out with student loan, with their forgiveness of their student loan plan. Did you see that?
Yeah, I did see this.
So just for those who aren't aware of it, Biden came out this week, and announced the Biden administration student loan debt plan. So they're forgiving loans of up to $20,000 if you went to college on, what's a Pell Grant?
Just looking it up now.
Okay, so thank you. $10,000 if you didn't receive a Pell Grant. And so literally they're forgiving $20,000 worth of student loans. That's huge.
It is a lot. It's federal grants usually awarded to undergraduate students who display exceptional financial need and have not earned a bachelor's or graduate degree.
Right. So if you got that grant and you didn't, you're either getting 20 if you did get the grant,
you get 10,
and otherwise you get 10. I mean, what's the average student loan debt in the US?
Huge. I don't know. It's pretty big. It's a hell of a lot bigger.
So there's no forgiveness if you earn more than $125,000. But also the loan repayment pauses have been extended through to December 31, 2022. Furthermore, which I want to touch on that in a second, undergraduate loans now have a new repayment cap of 5% of your monthly income. It used to be 10. So it's been halved, which means a loan just takes twice as long now to maybe repay.
But that's not unlike what it is here in Australia, where it's kind of tiered based on your income.
Yeah, that's right. But I don't believe there's a maximum in Australia. I guess the percentage is the maximum.
Yeah.
Okay. Anyway, that's changed. And what's being talked about right now is that, and what some of the data has been showing is that those payments are now going towards other loans. So there's the credit card loans, and so people are directing what they would have otherwise. So the repayment that has been paused, which has now been extended, the repayments paused, but those people, students, are now spending that somewhere else.
Yeah, right.
So it's kind of like kicking the can down the road and prolonging this thing. Or maybe it helps with the transitionary soft landing. I don't know. But I thought that was a pretty big announcement by the Biden administration.
It is pretty big. I've just found the average, which is a hell of a lot lower than I thought.
Is it 18 grand?
No, about 32,700.
Okay.
Average student debt.
So can you imagine
per borrower, and there are $1.5 trillion of loans outstanding. Fuck, that's a lot. But yeah, 32.
So you could have that more than halved potentially. That's huge.
If you knock $10,000 or $20,000 off that's massive.
Yeah. Plus the repayments have been paused. Wouldn't most people just put the money aside for the repayments they would have otherwise made and then make a lump sum next year?
Did you really just ask that question? No,
I was going to talk about Jackson Hole, but you've talked about it, so that's
bitch to it.
That's all good. Do you want to click on that link, the npr.org?
Sure.
So I want to bring this up. This is not a salami. This is not fake. This is actually real.
3-month-old salami.
2 astrophotographers teamed up to capture a stellar image of the moon. I thought this was...
Is that the moon?
That's the moon. It is absolutely amazing. So what they did was these 2 photographers, one of them, they took more than 200,000 shots to piece together this single image. One of the photographers, let me tell you the number, he took over 200,000 detailed photos of the moon from Arizona, and the other photographer took 500 images from Louisiana. So the guy that took the 500 shots, he was capturing colour.
Okay.
The other photographer was capturing detail. What they then did was they pieced together all of their shots and they designed that. They put this together. Like, how incredible and mind-blowing and almost mysterious and magical is that? That's the moon.
That's awesome. I didn't realise the moon had colour like that. I don't know. Never seen a coloured... Part of me is waiting for the punchline.
I did say this is...
Punk me?
Quote from the article, they combined their work by stacking the photos on top of one another to create a detailed image of the moon in spectacular colour.
That's pretty cool. Where's Neil Armstrong's little go-kart?
What?
You know, his little car he was driving up.
Is it
on
still
the moon.
there?
Well, I don't think they packed it up and flew it back. I think it's meant to be there, isn't it?
Maybe it's on the other side. I've got no idea, but I thought that was incredible, and I just want to share that. What else did I have here? Just click on that next link.
Did you do any work this week?
For us?
Just throw articles in here.
So there's a Bloomberg. Actually, you can go on the link, but there's not much. There wasn't a picture there. I thought I was going to show you. They're actually, which I'll bring out in a second, but the headline is, "Good luck finding a seat in that fancy airport lounge. In the post-COVID travel rebound, business class travellers are finding their lounges are packed, mostly because of credit card perks." And so I'll bring, and in that article, you can see the chart, which is a bar chart, which shows, and I'll bring this up now, which shows US corporate travel spend as a share of 2019 spend. So we're getting close to 60% of spending now relative to that of spending, I guess, at its peak in 2019.
So we're 60% of the way back to
That's
getting
right.
to 100%.
That's right. And if you have a look at that graph there, you've got 10% of 2019 in Q2 2021, and these are Deloitte's projections. And obviously 2022 is not a projection; that's actual numbers. But you can start to see Q2, Q3, Q4. Deloitte projecting us to get almost to 60% of 2019 spend.
Why are airports and
everyone's
planes struggling so much if we're only 60% back to where we were? Like, what happens if we get to 100%?
Well,
These things
if you're like Qantas, you friggin' sacked everybody. Now you can't hire anyone.
I did laugh that Qantas...
Did you get your $50?
Well, I laughed that I got the email saying, apologies for flight delays and whatever else. Here's $50 to spend on another flight. Like, dude, what are you doing? Like, people already can't get on flights and you're encouraging more people to go out there and book.
Although, you know what I reckon it was with marketing? It said you had to download the Qantas app. And I don't have the Qantas app. So I'm like, oh, shit, I've got to download the Qantas app. I bet you they're going to see a huge spike in app downloads. Now you're going to get push notifications. It's a scam.
Oh, absolutely. It's marketing.
$50.
Sure. $50. What's that?
$50. I mean, admittingly, I haven't.
Some shit.
Actually, I can't remember if I travelled to Qantas last time. But anyway, so people are travelling, and most people, I shouldn't say most people, a lot of people that I talk to who are away are either at the snow, or not quite now, it's getting to an end of snow season, and are in Europe. And so people are travelling a lot.
Seriously, it's crazy.
All
right, what else you got?
Next thing I want to throw out there, I want to talk about, there's this concept that people are now throwing about of normalisation rather than recession. So, this transition back to, did I say lunacy of 2021, moving to a more normal market environment in 2022. I don't know if you saw, but I saw this tweet. I don't know who Puff is, but Puff Yeti. He put this post up, and I'll bring it up now.
I mean, this is lunacy.
I feel like this sums up what was going on in 2021. So 1 year ago, this NFT of a rock sold for $2.872 million.
What?
Do I need to say anything else? Like,
no.
Just full stop.
Period. Like, what? Who in the... I'm not even going to bother.
So let's move on. I think I feel like that really sums and captures 2021. I couldn't get the last 2 years because I was using Google Finance. Someone else was in our Refinitiv this morning, so I couldn't use Refinitiv to pull these charts up. But the first one,
you just have to ask.
I want to bring up. No, I can hear you tapping away, mate, and clicking and getting your data. So this first chart is the last 5 years. The blue line is the S&P 500. And you can see the orange line is Shopify.
Man.
You've got the light blue line in Peloton. You've got Zoom in orange or yellow. And then in purple, you've got Netflix. It doesn't look too bad because it's 5 years, not the last 2 to 3 years. A 3-year chart is really what I wanted to look at.
Yep.
But forget the numbers, the percentages on the right hand side. Have a look at the chart, and have a look at the rise of share price and return for each of those stocks, and have a look at then the subsequent decline. So this tech wreck that everyone's waiting for, this 80 or 90%,
it's happened.
It's happened. We've done. We've had it. Let me put that into a bit more.
The only thing I'll say is all of those companies are still around.
For now.
For now, yeah. I'd pick one that won't be soon.
Did you see? So
But
Peloton, I'll just get rid of that one. See, Peloton are now looking at shifting their sales into Amazon.
Amazon, I saw that.
To me, that just sounds like
they are just scrambling.
Krispy Kreme going from this exclusive 4-hour wait to you can get it in 7-Eleven.
Yeah, I saw that and I went far out there just trying to offload these. I think I mentioned a couple of weeks ago that their stock has just exploded. They've just got so much on hand they can't get rid of it.
Can you imagine
and
the guys in the
increasing
factory that are like,
prices.
what? I don't know if they're increasing price. I think they're trying to bring out lower cost models.
Increasing. Anyway,
this is 12 months. So this is 12 months for S&P 500. S&P 500 is down 6%. Zoom down 74.83. Peloton down 90.35. Shopify down 77.34. Netflix down 57.47. Here's your friggin' tech wreck. Like this is, I mean, are we going through a process of normalization rather than this, what's the word? This capitulation and complete blow up of the entire stock market.
Yeah.
So I don't think it's the entire stock market.
No, it's not. But companies like Google, Amazon and Microsoft, they're all down 15, 20% still. Which, maybe that's okay. Apple's only down 6%.
But that if you look back in history, that is a normal drawdown, intra-year drawdown.
Relatively normal.
Normal.
Yeah.
We haven't seen that for so long, and so for a lot of people, it's a remote feeling to see your stock down 15%.
Yeah.
Index investors, they're not seeing or feeling it. They may feel like they're feeling the pinch, but index investors have seen nothing, in my opinion.
Relatively, yeah.
Yeah, absolutely. Yeah. Relatively speaking. Zoom peaked their market cap on the 16th of October 2020 was $160 billion.
Oh, right. Was it really?
At the same time, do you remember people were comparing Zoom to Exxon and were just absolutely baffled that Zoom had a much bigger market cap than ExxonMobil did? ExxonMobil at the same time was worth $144 billion. $160 billion for Zoom, $144 for ExxonMobil at the same time. Zoom was trading at a 300 times PE multiple. ExxonMobil at the time was 20 times. Zoom is now worth $25 billion. Exxon is now worth $412 billion.
This is Exxon's lockdown peak.
And I'll just bring this chart up. This is the post-pandemic slowdown. This is from Bloomberg. Zoom's days of triple-digit growth are behind it. You could literally, man, draw a line from the top left-hand side of the Q1 2019 and draw a descending straight line and cut the top off the pandemic because that was not normal.
That's interesting. No, you're right.
And that's what's going on with Zoom, unfortunately. They have so they're normal everyday users that paid, $14.99 a month, non-existent, gone.
Yeah, it's the enterprise business or the business user that's.
Well, do you know how many enterprise users they have?
Like shitloads.
What's a shitload?
I don't know. A lot more
What
than.
guess?
I've got no idea.
Globally, what are their enterprise customers? How many?
I don't know. 10,000.
3,000.
Really? What's enterprise? Like more than $1 million a year, $5 million a year?
I don't know what the number is. You're asking too many questions now.
Yeah.
But see, I thought that. So the likes of Teams. You don't need to pay for Teams. You don't need to pay for Google.
You shouldn't pay for Teams. That would be a crime to pay for that.
It's absolutely shit. Although I must say, in my limited, I should say limited. We use video a lot. Mm-hmm. We use Google. We use Teams.
Zoom.
Some people use Cisco, which is the absolute shit of the shit. And then you've got Zoom. Zoom, in my opinion,
is the best.
The best product.
Don't even compare.
The best product. We're not an enterprise user. We have our phone lines and our video is Zoom. We pay. We do conferences, and so we pay that.
Yeah, I think
it's worth every dollar for it.
Their phone line, it's just amazing. I just love using it. So it's through the computer. Plug in your earphones. Click on the phone number and it calls. Like it's just so easy. Man,
you can record.
I do.
It's perfect.
Like it. We sound like Zoom sales agents.
So I thought these things were really interesting in the context of what is going on now relative to what we have gone through in 2021, and maybe it's a period of normalisation rather than a period of boom bust. Like I just don't think it's binary.
Yeah, the bust is going back to normal. It's not really a bust,
Sure.
but it's just returning to normal,
Yeah.
perceived as a bust.
But once you change those words, I feel like, can you imagine the headline of the paper saying economy normalising or economy in recession, economy tanking?
How many newspapers will they sell?
Zero.
Not
Anyway.
many.
I think you got a couple of
I've
things
got
in here.
one. Yes.
Sure, go for it.
Finally got one in. Jesus. So I don't know if you have been keeping an eye on what's happening in the sneaker market, but this bloke, and I'm not going to be able to say his surname, Michael, do you have a crack at that?
Melchizedek?
Yeah, we'll go with that.
Melchizedek?
We'll go with, yep.
It's probably simpler than that.
So he's been charged by federal prosecutors in the
Who is
US
this guy?
for milking customers out of $70 million of cash and falsifying loan applications for around $15
There's a photo
million.
of him eating a sausage.
Really?
Zada Kicks owner and who's he a CFO for?
Well, Zada Kicks. So Zada.
Oh, I'm sorry. Okay.
Zada Kicks is a online shoe business. So what this guy was
So
doing
it's his company.
Yeah, so it's his company. He was selling rare shoes.
Right.
Sneakers, kicks, if you like, as the kids call it these days. So essentially he's saying, buy these Jordan 4s for $150 where you can't find them anywhere for less than $300-$400.
Scam.
People were massively skeptical, yet they still did it, and they were getting shoes, and they're like, oh, this is crazy. Like, what the hell? And then I think what happened is that was the bait. Do it a few times, and then screw you guys. I'm not going to send you stuff. And there were, in the article, there's people talking about, I've spent $70,000 on shoes, and I am still waiting for the shoes to come in. Like, holy cow, dude. Anyway, so authorities are kind of portraying him as the Bernie Madoff of sneakers.
Of course they are.
Love it, right? But now they're selling 59,780 pairs.
Who's they?
Of
Zadek.
federal prosecutors. So basically, the courts have said, you do have all these shoes in warehouses, 60,000 pairs of shoes boxed up in a warehouse. We're going to sell them all.
Oh, so
and
he
give
did have the
people
shoes.
money back. Yeah, so he had the shoes, but just never delivered. Like, took the money, didn't give them the shoes, and just went and bought Lamborghinis and lived the life. So trying to get.
Meanwhile, the
have his
product's
cake
actually there.
Yeah, the product's there. How crazy is that? Anyway, let's bring up this table here. These are the sneaker brands and the number of pairs of sneakers.
Shit,
that he had.
59,780 pairs.
So he had 48,300 pairs of Nike shoes.
No one wants Reeboks.
Yeezy, Adidas, Vans, Asics, New
Miscellaneous.
Bloody New Balance, Converse. Anyway, and let's just bring up this chart. I found this as well. It was on Bloomberg from StockX, and this is Jordan 4s and Nike Air Max versus the S&P 500 since the bottom, or COVID. Let's call it COVID. And Jordan 4s have done exceptionally well.
Put that in your super fund, guys.
I couldn't find a longer period, but I think some of the Jordan 4s and the early Air Maxes have done exceptionally well in terms of price. But anyway, so this guy has basically thrown in jail, getting all his assets distributed. And I think the prosecutors or the judge made a point of saying the first lot of shoes to be sold are your personal collection. It's your personal shoes that you've got in your house. They're the first ones to go, buddy. And then we're going to hit the warehouse and the rest are gone. So
Wow,
anyway.
how didn't you... Yeah, I would have thought this through a bit more. Surely.
Yeah, $70 million. Like, I knew sneakers, I knew the secondhand sneaker market was a big business, but $70 million of customers' money that he's kept before people stop buying, like sending him money to... Anyway,
Probably more luck
crazy.
in someone from China sending you something on Alibaba than this guy sending you anything.
Well, I was thinking the Tinder swindler. Man, this guy just reeks of the Tinder swindler.
Yeah, he's a shoe swindler.
He is the shoe swindler, absolutely.
What do you got for us? Tips and recommendations.
Yeah, all right. So we had my boys play soccer, football, and we were out in Croydon last weekend.
Did you find another burger place that everyone knows about.
This place called McDonald's. It was amazing. And I was just Googling it now. I can't remember the name of the place. But anyway, we went to a brewery. I'll look for it while I'm talking. Maybe you can look for me, mate. This is how organised I am today. Anyway, we went to this brewery in Croydon.
Is it called the Public Brewery?
Maybe.
Hey, this is a terrible tip.
This is terrible. I
don't even know where to go.
Anyway.
All right, let me go.
Why don't you go
you can find
Google
the friggin' brewery that you went
sort
to.
my shit out.
So I haven't been here in such a long time, like decades. And our kids have got birthday parties every single week. Week in, week out, we've got birthday parties. We had a birthday party in Preston on the weekend. So we were looking for stuff to just do before the birthday party. You found it good.
It was the Public. Anyway.
There you go.
Go for it.
And so we went to the Preston Market. Have you ever been to the Preston Market?
No.
It's pretty cool.
Is it?
Yeah, like
Okay.
it's, it's one of those things where they've got cool little, organic store here and a coffee shop there. And
It's a big open parking lot, basically, with a bunch of stores, or is it
no,
a bit more...
it's got a big open parking lot. It's kind of undercover in sort of sheds, sort of scattered sheds, if you like.
Yep.
And Deb found this place that sold Turkish, like pidez and böreğs and stuff like that.
Okay.
And they're all vegan. And we're like, wow, can't wait to go to this place. So we got there and we're like, shit, there's only like 3 like triangle, pastries left. I'm like, let's grab all 3. We were so underwhelmed. We got them and we ate them and they were nice and whatever. We were walking around. Deb peeked her head around the corner. She said, let's go to the fruit market over there and we'll grab some things and whatever. And we turned the corner. Next thing we saw is this fucking massive börek shop called Tammy's Böreğs. That's the vegan one, not the place that we bought all the stuff from.
Right.
And we went in there and this place was absolutely pumping. Like, who would have thought like this Turkish vegan bakery is pumping? But we were so full from the guy before. We're like, we did it again.
Oh, really?
And
Double down
on it. And the food's so good. So any vegans listening, go down to Tammy's Böreğs at Preston Market. It's pretty cheap and they've got a huge variety there. And it's bloody good. Not gluten-free, unfortunately, for you. But actually, you wouldn't enjoy that there. There's not much there for you to do. So for all the
What's that mean?
because like it's not gluten-free and really that's the only thing that was exciting for us down there.
Oh, okay.
We wouldn't have gone there actively if we didn't have the birthday party, to be honest. So Tammy's Böreğs, massive shout out. Freaking awesome. What do you got?
Good one.
The Public Brewery.
So I went to a place in Croydon called the Public Brewery. Have you heard of it before?
No, I haven't.
There you go. So anyway, it was really good. Played soccer, beat them. Went to the brewery afterwards, a few drinks. And a thing that really stood out for me is, and all the parents commented, we're looking at the menu and they're like, hey, Matt, they have a gluten-free beer section.
Wow, a section.
On the menu. Not just whatever. There were 4 or 5 different gluten-free beers.
And you would have been
O'Brien's was one. I'm still waiting for the sponsorship, by the way, O'Brien's. It was great. Food was pretty good. There were a few people in there too. So it was like 11:30, 12 o'clock.
Lots
on a Saturday.
Vegan options
Nice
too.
kind of cozy atmosphere. It was pretty cool. So
Is that a thing you do, like soccer and then brewery? Soccer or lunch, soccer or food?
and then we would go away. So like we went up to Healesville. We've been to Yarra Valley. We've been to Monbulk, which is miles away, and Croydon. Not that that's that far away, but it's just kind of that. We're out anyway. Let's
that's good
hang
fun.
out. It's good fun.
And you normally go with the team?
Yeah, part of the team. Not everyone. I mean, everyone's got commitments and whatever else.
Party
And
poopers.
kids have to race off to play basketball after they play soccer and all that. But it's usually a few of us. But
nice.
Yeah, so 2 more games left in the season. I don't know what we're planning, but
Where are the boys on the ladder?
they're both home. Third. 1 point behind second, 2 points behind first.
Couple more
It's been a
games.
good season.
Got to get that
good
percentage
fun.
up
Anyway,
as well.
yes, they need to get their shit together. And look, the only other thing I was going to mention is I was at a Father's Day breakfast this morning, nice and early. at the boys' school. 7 o'clock, roll up.
Far out.
Yeah, man, it was bloody early. And it was just, kind of celebrating dads, and it should happen more than what it actually does.
Father's Day is every day.
Mate, I'm living in the wrong house if that's the bloody case.
I'm saying it should be every day.
Yeah, it should be.
Yes.
It's not, but it should be, absolutely. And there was a guest speaker there, a bloke I'd never heard of before.
What's his name?
And his name, I'm just Googling it now, Chris Henderson. And they kind of introduced him as a Richmond football player. And for those of you who know me, I don't know much about football at all. And he got up, and he's actually a Richmond football player for the wheelchair Richmond football, which is
right.
WAFL, I guess.
I think that's women's.
Oh, okay. Oh, here it is. VWFL, a Victorian Wheelchair Football League, I guess that stands for.
Yeah.
Anyway, this bloke was really, really interesting. So he's in his 40s, diagnosed with multiple sclerosis a few years ago, and said it just completely changed his life, as it would, but it changed it in a positive way. So he was talking about how he's now got a really positive outlook on life. He's using this disability to get little kids involved in sport and all that. So just kind of got me thinking. It's really kind of stuck in my head as we kind of lead into Father's Day, just about appreciating those things that mean the most to you. And he was saying, it just took him 16 months to kind of get his head around it, to start looking at it positively, and just kind of step back and go, all right, what's important to me? Spending time with family, friends, check in with friends more often, that sort of thing. So Father's Day coming up. By the time this drops, it'll only be a few days away. So enjoy your Father's Day, enjoy time with family, kind of treasure those things that are important.
Yeah, it's a good excuse, but I think as we live our lives, we just tend to not think about these things,
wrapped up
right?
in the busy day today, right?
Yeah, and I think you and I were talking about this the other day, like how much our mindset and the stories we tell ourselves and the perception we have just really creates the reality for ourselves, and how much in control we are with of that, right? And I was chatting to John, my business partner, and he was saying that he was chatting to someone else who's just got this constant negative outlook, like everything's just shit. Everything is just shit.
Right.
The day's not going right. The weekend didn't go right. This is not right, and that's not right. And John's like, mate, how the fuck do you live your life like this? Like, how do you constantly live a life of everything's wrong all the time?
Yeah.
And I just not sure how that's a very enjoyable perception. And you could participate in life in a very different way than the story that we create for
and
ourselves.
I think it's a conscious effort, I think, for a lot of people to
because the default is
focus
that.
on the positive, right?
Yes.
Yeah. I mean,
the default is to not to.
Yeah, absolutely. It's a conscious to go, all right, I could focus on that, but let's focus on the positive. And it's so hard at times. But I think as a society, we need to do that more and more.
Yeah.
Man, we could start a philosophical podcast.
Yes, the wide lens on philosophy. We're going to wrap it up. We will catch you
Anyone
guys.
that's still with us, thanks for listening.
We'll catch you guys next week.
Cheers, guys.
My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management, AFSL 526 798. The information contained in this podcast by me, my colleague Matt Rigby, or any of our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.